Hey everybody, I hope you had a really great week. Welcome to another weekly roundup of our trader use group. This is for trading week ending November the 14th, 2014. As you see, what I've got on my screen here is the cash index, the SPX. And I wanted to just go through a couple of things with you here. We're going to talk about the cash index of both the SPX, the Dow, and the Russell. And then we're going to cover briefly the 30-year long bonds. We're going to take a look at metals, gold and silver, and we're going to take a look at oil. So there are a couple of things that are starting to shape up here that I think are really important. As you see on the screen right here, I have a weekly chart of the SPX. And there are things that are starting to show up that could mean that we may be in for some rough times here coming up. And it's not a cause of concern right now, but I do believe that it is something we've got to pay particular attention to. Now, what is it I'm referring to? Well, if you look at the chart here, you can see that I've got this channel drawn in, coming all the way back to January of 2013. And you can see that starting in April of this year, earlier, actually, sometime around the end of the first quarter of 2014, I have another elevated channel within a channel here of the cash index. You can see that we've honored these channels very closely, and we've stayed in them for quite some time. But now as we reach a peak up in this area here on the right-hand side of your screen, you can see we are setting up, and we've been setting up for almost a year here. Actually, this right here is 2013, not 2014. And this comes back in for over several years. So we've been in this pattern for quite some time. But I wanted to show you that as we are making new highs in the cash index, we are setting up for a rollover in the MACD. That, folks, as we say in our logo here, is a bed or a bearish divergence. Now, what bearish divergence means to you is that there's weakening volume pushing the indexes higher, or weakening strength. It doesn't tell you how far the markets will go up or how far they will fall, but it does tell you that they will fall. And on this weekly index here, we're getting this across all indices, as I indicated here. So we are nearing the northern boundary of this channel, and you can see going back several years we have not penetrated this northern boundary. In fact, we've come up to it, but every time we've met it, we pull back, either to a little interim channel right here or down to this longer term channel right here. So that would suggest a pullback south of 1980 all the way down to about 1900 going into January. Now, I know that traditionally November and December are strong months for the market, and they've been that way. If you can look at the statistics, that's what it shows. But you guys, how many times do you find out that statistics and history sometimes will get you in trouble? And I'm not saying here or suggesting that the markets are going to do that pullback. I am suggesting that you've got to be very careful with where the market is right now. What I'm instructing our members in our group is to not be over allocated to the long side. I'm about 40% long. I took some profits off, and I've been trading mostly range bound to slightly bullish, but it's been working for me. But you've got to remember where we're sitting in a longer term perspective. We've been moving up for quite some time here. Now on this daily chart of the cash index, you can see this blue dash line is where the cash index opened for 2014, and you can see where we are here, and we are at a point where the market seemed to be getting a little bit tired on this daily index. Now, on this daily index, for those of you that understand Elliott wave theory, and you can get lost in the theory, and I'm not much for theory, but I do use it to help judge price action and where we're going, and where the opportunities could come up. So if you look at the Elliott wave theory, we've got a 3-leg up here as we're nearing the upper boundary of this channel, which, as I remind you, goes back many, many years. And then that traditionally means you have a little bit of a pullback into a 4, and then a final thrust higher into a 5. Now, on this right here, there is no bullish divergence or bearish divergence. In fact, this is a valid move right here. But should we get a little bit of a pullback, profit taking through the end of the year or into January, we'll probably get that one thrust higher, which would give the MACD one of these kind of patterns like this. And that pattern like that would give us a bearish divergence on the daily. And if you've got a bearish divergence on the daily and the weekly, watch out, because I think we'll come down and test this lower channel here, which is a channel within a channel, and then possibly even come down and take it down to here, or maybe even lower. So as we get towards the top of this channel here, which we haven't broken in the past 3 years, I'm starting to shift my position deltas. I'm starting to shift my thinking from just pure bullish, which is where we were in this big run here, to as we get here, we got to trade this. We got to assume that there's going to be downward forces acting here, which will move the price down and give us a 4-leg, possibly around the 50 EMA, which is sitting at 1974 right now. Okay, now this is the cash index. So this is kind of how I'm looking at this as we go into the end of the year. Also, the other indices, which I'm going to point out here in just one second, are shaping up to be the same as this index right here. Okay, so that is how I'm seeing this right now. So let's go look at the other indices here. So if we look at the Dow index, the cash index, let's come back out to the weekly again. We'll step back out in time. And as you can see, this one right here, I've got it back to 2011, just like the cash index for the S&P. And you can see here, we've honored this trend line for quite some time. You can see in this weekly trend line, again, the same pattern that's setting up on the cash index for the S&P 500. Every time we hit the top, we come down and we test towards the lower portion here. And we have not broken the top, nor have we broken the bottom. And you can see some of these tests here as we come down. In many instances, the 50 EMA, has served as support for the index. But in all cases, the bottom part of the channel has. And if you look at this setup right there, folks, again, that gives us a bed or a bearish divergence. And that concerns me. Now, keep in mind, this is a weekly chart. So a time frame of 6 months is only just that amount right here. So this means it could take anywhere from 3 to 6 months for this thing to come to fruition, which means we could have a final thrust into the end of the year, November, December. And then once that thrust happens, we kick off 2015 in an ugly way. But I wanted to remind everybody, up in this area up here, again, just like the S&P 500, I've got my portfolio not quite as bullish as before, and I am maintaining a stance here that is very cautious. Okay, if we come into the daily, now if we look at the daily on the Dow, you can see here the channel. Again, we have not hit the top of the channel. But as we come through the end of this year, which is traditionally, as I said, a strong time for the markets, you can see here we've got an Elliott 3 wave, and traditionally it's met by a profit-taking leg, which would give us a 4, and then a final thrust higher, which is 5. We do not have bearish divergence on the daily, which would suggest some profit taking, a little bit of a move lower, and then a little bit of a thrust higher like that. Because remember, in a Elliott wave 5, you traditionally do get that bearish divergence. Okay, that's what you normally see there, and then that's when you have a little bit more chop here. So in this area right here, I again have shifted my portfolio for anything that I'm tracking here, and it kind of follows suit, right? I mean, we're at all-time highs here on the Dow. We're challenging these all-time highs on the S&P 500. So it's lining up that way. Now, if we look at the Russell index, and we step out to a weekly, and let's just back out again so that you guys can see what I'm talking about here. Here's the Russell index. You can see, again, same pattern. Again, this is a weekly chart, but there's a difference in this pattern than the others, okay? And the difference, I think a lot of you probably already are aware of it, but the Russell is basically a, comprised mostly of small capitalization stocks, okay? And so it's, we say it's the small caps. But we've honored the this channel going all the way back again to 2010. This is a long time to be in this upward channel, in fact, prior to 2010, right at Q1 of 2009, we've been in this channel. But again, look at the bearish divergence on this thing setting up. As I said, we call it a bed in our chat room. Its thing is setting up, and but now on this one, the only thing that's different here is that we are getting this downward channel within a channel like this. Okay, again, this is a weekly, but you can see this channel within a channel here. Guess where that's pointing? It's pointing down within an overall uprising channel here. So what does that mean? Well, the Russell traditionally leads all other indices up and down. Why? Because it's small cap. When this thing is going up like this, that means risk. Money is willing to accept more risk, and everybody's happy because they're putting money in the Russell because they're small caps. So if you're willing to take more risk, you want more return in search of yield. When risk is off the table, then money comes out of this, and this thing starts to have this pullback, like you see this channel within the channel right here. And we've been in this for the entire year of 2014, the entire year. So that just says that as we move up in the Dow and the S&P, we're getting supported by fewer and fewer stocks. We're not getting follow through in small caps. So I'm just letting you guys know that I'm raising the flag from green to yellow, which means caution, and we've got to be careful here. Okay, I mean, we've just got to be careful. Now, that's not to say that we haven't been crazy bullish taking advantage of these moves. We have. But we want to be cautious bullish, not crazy bullish. And that's a little bit about, how this thing is shaping up. If we come into the daily right here, you'll see that we've made new highs in other indices. We have not in the Russell. And you can see right here in the Russell that in this Friday, the Russell didn't have a good day. Thursday, the Russell didn't have a good day. We're on a 3-leg here with the Russell. So again, we could get that pullback from a 3, profit taking down to the 4, and then back up. One thing I want you guys to, it just kind of snuck in there. I think a lot of people, in fact, the press, I didn't see too many people in the press talk about it either. But, we caught it, and I told people about it. But if you look here, we've got an ominous sign of the 50 crossing below the 200, okay? Now, they're both It's not as worrisome just yet because they're both got a slight upward vector on this. But nonetheless, the 50 went below the 200. A lot of black boxes, a lot of automated systems caught that and probably generated some selling here because some black boxes are programmed that when, the 50 grows below the 200, sell, reduce some of your longs. And that, I suspect, is partly what's going on here for those that are so technically inclined. But again, we got a 3-leg. We'll come down, possibly test a 4, have a final thrust higher 5, and then we're going to give it up. That would be if you believe in Elliott wave theory. Now, theory is one thing, but practicality and what the markets actually do are another. From this high here to that high there is no bearish divergence. So this is a valid move. Money came into the Russell, and now we're getting a normal profit taking as we go through the end of the year. I think you're getting some hedge funds and folks trying to just take some profits off the table for fear of a little bit of stronger pullback. So that's given us some weakness right here, all right? And you guys probably noticed that on this one right here, on the Russell, the channel is a lot wider than the channel on the SPX and the Dow. Right? I mean, if I zoom in a little bit, you can see just how wide that channel is. If we give it up and start falling, then obviously this double, the 50 and the 200 is going to serve as pretty good support for us around 1130 area. But that's kind of where we're sitting right now. If we look at bonds, let's stay on the daily here for a minute. You can see bonds really for 2014 have had a good year. I mean, excuse me. If you look at the bond market, I've got this upsloping trend line surrounded by that shaded blue area. So it's really an upsloping zone more than it's just a pure upsloping line, right? But you can see this was the low point starting January 2nd of 2014. And we've done nothing but go up for the entire year. And granted, we've had some pullbacks, but if I were to draw a channel like that, which I probably should, I'll put on my chart later, you can see we've been in this channel. Now, you don't normally see bonds moving up and equities moving up. The typical correlation is bonds will move down, interest rates will move up, and the equities will move up. We're not getting that correlation right now. We do not have a bearish divergence between this point and this point right here. And by the way, these spikes up were just a very unusual couple of days in the bond market in U.S. Treasuries. Over almost $1 trillion changed hands. Just an extremely abnormal day. That was the blow-off bottom that we had in the equities when we started to form that V bottom moving back up. But you can see here we've got a turn up in the MACD. You can see that little rounded area there like that. So it could be forming one of those traditional cup and handle kind of patterns, and then a final thrust up into this area, and then we give it back up. But right now, near-term bonds are up a little bit, but I've been playing this going outside of this area right here and just shorting calls outside the money, because I think if we do get that pullback in the equities, bonds are going to end up back up in this area here. But then right in that area here, I'm suggesting to our members that we sell into that rally, because I think bonds are going to fall, but not as fast or as much as people think. Okay, that's just kind of been the thing that's fooled a lot of people, or caught a lot of people in a trap that like to trade bonds. And I have to admit, sometime in the middle of the year, I thought bonds were going to come down much sooner, but they haven't. And the primary reason this money is flowing into the U.S. Treasury market in search of yields from Europe. If you look at the government instruments there, the government treasuries, the government notes there, they're lower interest rate than they are here in the U.S. So that's why money is coming into the U.S., into our notes. And to buy the notes, it takes U.S. dollars, which is why the U.S. dollar has just been so strong. We've been playing that to the upside. And if we come down, and I'll skip currencies, we got a lot of interesting things going on in currencies. By the way, if you're not a member of our group, I highly encourage you to come on in and check us out. We've got monthly, semi-annual, and annual membership options. We've got a number of really cool webinars getting ready to kick off, one on position management and trade adjustments in the option world. And we got a number of other things happening too, so I'd highly encourage you to check it out. But if we come down, we had some really good plays in the yen, the pound, and the dollar, including the Australian dollar. So just a lot of things going on right now on the currency side. If we look at gold, let's come into the gold futures, and let's step out for a weekly just for a second so you guys can see this. Here's the weekly in gold, and you can see we've been in this down channel for quite some time. The shaded area is a very solid support point. I mean, you can just, if I just back out, you can see on this weekly chart just how important this shaded area is. There's the downsloping channel taking us down to a possible 1,000 level, which I don't think gold will go below that. But you can see this. And gold has been very volatile within this channel. When it hits the bottom, it moves up. When it hits the top, it moves back down again. We've had the 50, we've had the markets just really, ever since the summer of 2013, or actually going back to 2012, we took this gold short position way up in this area here, and we made a great deal of money from that one right there. Now, where are we with gold? I haven't been trading it for the past month, but if we zoom in on the daily, you can see the bias is down, okay? But right now we're in one of these bounce situations. So you can see down below in gold, we do not have a bullish divergence. Now this is a daily chart. I've zoomed in just a little bit. There is no bullish divergence in this guy. So what does that mean? Well, that means we're probably going to get a little bit of a bounce back into this wide support zone, but then the odds favor a roll back down again, test that pivot low, and then come down even lower. You can see right there we've made lower lows, so there is no bullish divergence right there. From that point right here to this point right there, or that point right there. So a move up, I would not get suckered into this thing. Rather than, you could day trade this to the long side because these move ups tend to be sharp. You can see every time we've had these move ups, they're sharp, but they don't last very long. They'll last a week or so, and then they'll play themselves out and roll back over again because bears take over and push it back down. At some point, this pattern's going to change. But until it does, I'm going to be more of a seller into rallies with gold than a buyer on dips. Although if you want to day trade it, there are some very fast day trades using GLD or gold futures to be able to play it that way. Okay, so that's a little bit about how this thing is stacking up in gold. And let's look at silver. Silver's a really cool one as well. Silver futures, you can see, let's come back out to the weekly. You can see the same pattern in silver. There's that downsloping channel. We've been in this channel since the summer of 2012, and it has just honored this channel all the way down. Now we're in this shaded zone, which is a support zone. Again, this is a weekly chart. You can see right here where we're sitting. A lot of people didn't think silver could go below 20. Well, here we are sitting just north of 15. And we just have not been able to break out of that northern boundary of this channel. If we break out of it, then I would be more inclined to investigate longs. Now, silver is different. On this weekly chart with silver, unlike gold, we are starting to see a little bit of a consolidation and a possible move higher. So I would be more inclined to play silver to the long side than gold. You can see what we call in our chat room a bullish divergence or a bud right there from that low right there to that low right there. So if we can break that channel, move to the outside, I think the first test to be the 50 EMA, the second test to be the 200 EMA, but this is a weekly chart, but that's where the test is going to be on the daily. But if we can break out of that, then it could be a pretty good move. Silver on Friday closed at 1630, all right? And I told folks sometime by next year, silver is going to be back north of 20. So this is an area where we may want to start looking at accumulating or playing either the ETF SLV, or for those that are properly capitalized, trading silver futures, and start to accumulate a little bit. We are still in a downtrend, and until, for those of you that are more conservative, until we can break north of this channel, then you could just sit on your hands and hold. It's hard, I know, for a lot of you to have patience, but that would be the play here. I would be more aggressive silver than I would be gold. Silver is underperformed gold, which means I believe silver is going to overperform gold back to the upside. Okay, and it's a cheaper instrument to trade, although in the futures market, it's a lot more expensive to trade silver. The contracts are fairly big. The margin is a lot higher as well. So I recommend you have at least over a couple of 100,000 portfolio to trade silver futures, although SLV would be the play to go. If we come in on the daily, and let me get the sub chart back up here again for you guys. Let me just restore the where are we here? Let me get it up here. I'm going to restore the sub chart for you. So now, if you look at the daily, you can see just where we are here in this. Let's zoom it out a little bit. You can see here there is really not a lot of bullish divergence on the daily, just like gold. So we're having a little bit of a counter trend rally here. We're still in this wide zone that covers from about 15 to about 1850. We're in this choppy area here. The 50 EMA is going to serve as overhead resistance, but if we can get up in this area here, I don't mind taking a little bit of a risk, a small position in SLV with options, but you're going to have to be longer term in this guy. I think this time next year, silver is going to be back over 20. But between now and then, it's just going to be choppy. And if it moves down a little bit lower, add to your position. But so don't go all in right away. At least that's what I'm instructing our folks to do, or that's what I'm doing. If we look at oil, let's look at the oil market. This is a daily chart of oil. Let's step out to a weekly here just so that you guys can see what we've done. It was really interesting. We had a really good setup here with oil play into the downside. You can see that symmetrical triangle right here. And I said, I don't know which way it's going to break, but whichever way it's going to break, we're gonna play it that way. Let the price action tell you what to do. And sure enough, we traded from the low to the high of this channel, and we were in it for a long period of time. We finally broke it. Let's see, that goes back 2013, 2012, 2011, all the way back to 2010. I mean, we've been in this just channel here. And we just have not been able to break out until right at this point here. You can see this very tight channel. We'll zoom in a minute on the daily chart so you can see it. We're down at this key support area right here. Call it 75. It's 74.95, but let's just call it 75. It's a psychological barrier for oil. We've got a big OPEC meeting coming up the end of this month. 50% of the analysts say they're going to cut oil production. The other 50% say the Saudis will not, and the Saudis will force oil down lower. Where can it go? Next stop, 65. All right, that's the next stop for oil. You can see sitting at key pivot right there, right around 65 is the next stop. And then from there, the psychological barrier of 60. And if you don't think it can get that low, go back to 2007, 2008. In fact, just to show you guys, one of the best trades I've ever made in my career was trading oil to the downside when everybody said oil was going to go through the roof. Goldman Sachs, I remember it like it was yesterday, he said oil was going to $200 a barrel. Right in this area right here. You can see how fast oil can move. Now this was in the summer of 2008. Oil got up to about almost $150 a barrel. Right up in this area up here, I shorted oil with several contracts and rode it all the way down, and I got out in the low 60s. I didn't get too greedy, but you can see just how low oil can go, and we can put in here this key pivot right there at 50. But oil got down to $33.20 a barrel in the futures market, the continuous futures market. So don't believe that oil can't go down any lower, because it can. And we've got a lot of factors influence in oil, primarily the global supply and inventory levels. As the U.S. continues to become an international player. If the Republicans get through some of their bills in the Senate and Congress, they may allow for the laws. A lot of people don't realize there's laws on the books that limit the amount of exports the U.S. can do with oil. They want to export more oil, become more of an international player. That'll improve our U.S. GDP numbers. So you can see that oil can go a lot lower. So, and we have absolutely on the weekly chart no bullish divergence. So be careful with this little interim move here. If we come into the daily chart on oil, you're going to see here this little channel moving all the way down. We've kind of overdone it just a little bit. I'll blow it up. You'll see a little bit of a bullish divergence here, which says anticipate a rally into the OPEC meeting, I think, coming in for a couple of weeks. And then the OPEC meeting is going to say, or is it going to come up and challenge the upper portion here, or are we going to roll back over and just start going down and continue our trek down? Not really sure. Who knows what these Arabs are going to do, but right now we could just anticipate a little bit of a rally. But be very careful. We are still hard down. We're outside this channel in a steeper slope down, and we've got a little bit of a bullish divergence, so that says here's just a little bit of an odds to bring oil back up to around $80 a barrel, which would put us back into this channel again, and then we'll see how it goes. Also, for our members, this Sunday night we'll meet. I'll show you guys where we think where I think natural gas is going. That's been an interesting play. We've got plays in the agricultural market. In the meat market, be careful here. We're setting